In today's video, we're going to break down how to minimize your taxes in retirement if you've saved $1.4 million in your RRSPs. Over our many years operating in the financial industry, we've walked through this situation countless times, and the results may shock you. Navigating the world of taxes are confusing at the best of times. Yeah. It's even more confusing when you factor in differences in account treatment. Well, in today's video, we will not only be discussing how to minimize taxes at age 61 with $1.4 million in your RSPs, but also the exact decision-making process that allows you to do the same. Here we have Jane's financial plan. We use a software called NaviPlan to run our financial planning projections. In Jane's example, she's retiring at age 61, and we have life expectancy at age 95. As we discussed earlier, Jane's net worth, she has $1 million principal residence, and she has $1.4 million in an RRSP in a portfolio that should average just under 7%. As discussed, Jane's lifestyle expenses are $5,000 a month after tax or $60,000 a year, and she's targeting a vacation of $10,000 a year. That's $70,000 in after-tax expenses that she would like in retirement. And for our example, we have Jane eligible for 100% of CPP and 100% of old age securities. As you can see, I have Jane starting CPP and old age security at age 65. Now, as we know, there are options to take CPP early or defer CPP to take later than 65. For our scenario, I've determined that it makes sense for Jane to take at age 65. One of the reasons is I dislike having a reduction in your CPP benefits by taking it early. So in this scenario, let's take a look at cash flow to see what her RSP income will be. Now this screen is showing us 10 years worth of cash flow starting in 2024. As we can see, the program has determined that Jane must take approximately $89,000 from her RSPs in 2024. That's to cover $60,000 of living expenses, $10,000 of vacation, $70,000 all in. The program is calculating that she has an approximate $19,000 income tax bill. Now, typically, it overestimates what the tax bill will be because it's unaware of any additional deductions or credits that Jane might be eligible for. So as you can see, including income tax, her total cash outflows is $88,964, which matches her inflows of $88,964 from her RSP, bringing her annual surplus or deficit to zero. And that's ideal. That means we're taking just enough out of her portfolio to satisfy her living requirements. You can see the next 9 years, the surplus or deficit is zero, and we can see the amount that Jane is taking from her RSP. Note at age 65 that she takes less out of her RSP. That's because her CPP and OAS are starting, and she can expect approximately $27,000 indexed to supplement her RSP income. This example shows her base plan where she just draws the appropriate amount out of her RSP. Let's see what her net estate will look like at age 95. This screen shows her net estate in 5 different years. Current year, 2024, age 95, 2058, and 3 years in between. Let's focus on age 95, 2058. If Jane changed nothing about her expenses or her RSP withdrawals, her RSP would be worth $875,000 in 2058, principal residence $2.7 million, so her net worth would be $3.6 million. The CPP pays a death benefit of $2,500, bringing her estate before taxes and expenses to $3.643 million. Her final tax bill will be $447,000, which is fairly significant, but it's because she has such a large RRSP. As most of you know, when you pass away, the value of your registered accounts, whether it be an RSP or a RIF or a LIF, it becomes taxable income. In this case, Jane's RSP was $875,000, and that's all income in the year she passes away, which puts her into the highest marginal tax bracket of 53%. On top of her tax bill, there will be probate fees of $54,000, and this would bring her net estate to $3.142 million. This is a scenario where Jane is just drawing the appropriate amount out of her RSP along with CPP and old age security to fund her lifestyle. Let's see if we can make a change to reduce her tax bill or increase her net worth or net estate. In this new scenario, I've decided to take advantage of the tax-free savings account. In the previous scenario, Jane only had an RRSP. In this scenario, we'll be taking more out of her RRSP and funding her tax-free savings account before she starts to collect CPP and OAS. Let's take a look at cash flow. Similar to the previous example, here is 10 years worth of cash flow. As you can see, from 2024 to 2027, Jane is drawing out $112,000 each year. I used $112,000 as an RSP withdrawal because that brings her to the top of the income range where the marginal tax rate is at 37%. So if we see in 2024, her RSP income is $112,000, her outflows are $70,000, broken up between $60,000 living, $10,000 vacation, and there is her TFSA contribution. That was the surplus amount that was left over after taking more out of her RSP. Tax bill is a little bit higher this year because we took more out of her RSP, but you can see that her outflows equal her inflows because we've made those TFSA contributions. Again, seeing zeros in the cash flow projections is not a bad thing. It just means that we're taking the appropriate amount out of her portfolio to fund her lifestyle. As you can see, in 2028, we stopped taking out that additional out of her RSP, and she takes out $71,000 to supplement her CPP and old age security. Now, let's see if our plan worked and see if her net estate is more than the previous example. Let's focus on year 2058 at age 95 for Jane. We can see that her RSP is worth $889,000, slightly higher than the previous example, but she's also managed to have a TFSA of $333,000, and her liquid assets are $1.2 million. Principal residence stayed the same value at $2.76 million as in the previous example. Her net worth is now $3,989,000 at passing. Add in the $2,500 from CPP death benefits, her estate before taxes is $3,991,000. Tax bill, $455,000, slightly higher than before because her RSP was slightly higher. Probate fees, $59,000. Her net estate is $3.4 million. That's $300,000 greater than the previous example. All we did in this scenario is took more out of her RSPs before she started receiving CPP and OAS, and it increased her net estate. There are far more variables that we can change in the financial plan to minimize tax or increase the net estate. Talk to your financial advisor or come see us at the McClelland Financial Group to see what scenario fits your life.
Now you know the decision-making process that minimizes your taxes, and now you can do the same. However, there are multiple factors that we haven't been able to cover in this short video. If you have any questions on any of these or want a team of professionals to analyze your situation and create an optimal plan completely tailored to you, click the first link in this description. It will take you to a page where you can book a completely free consultation with us, where we can begin to help you build the retirement of your dreams.